Okay, let's go ahead and get started. Listen, I want to welcome everybody to our first webinar in 2014 for Wednesday nights, and we're going to call it Wednesday Night Live. And every Wednesday, we're going to have really a different speaker. For example, next Wednesday, Stan Dash from TradeStation is going to be here, and I'm going to introduce Stan, and then he's going to talk to us about Radar Screen and how to use that. Then the following week, we have Wesley Sinks from Ninja Trader speaking about the Ninja Trader platform. So we're going to have a variety of different speakers. I'm going to kick it off tonight, and then from here on out, we're going to have different professionals in the industry come and speak to our group. And we really plan to have a lot of fun with this. We want you to ask questions, of course, during these webinars and really get something out of it from an educational standpoint. We're going to be listing who's speaking in our forum calendar, I guess was what we call it, as well as our upcoming events webpage. And of course, we're going to be posting this in email. So you definitely want to stay with our email list so you get the latest updates on who's going to speak and so forth in terms of registration as well. All these webinars are going to be free. There won't be a confusing password or anything like that that you'll need. You'll just be able to click on the link, register very quickly, and then you'll get automatically a link back from our webinar software folks at Citrix with an access link that you'll use at the time when the webinar starts. So we're really excited about it. We're going to work hard at bringing some good quality educational material to everybody during the course of this upcoming year. So I hope everybody had a good 2013. It was a great year in the markets. And now it's time to roll up our sleeves again and get ready for 2014. And of course, those of you that are out in the Midwest, I hope you're starting to warm up a little bit. I hear the weather is going to get a little bit better during the weekend, so you'll get above freezing, and that's certainly a good thing, especially with the weather you've all had back in the Midwest as well as the East Coast too. So San Diego, where I'm from, has been a little spared from the weather. But still, for example, last night it went into the 40s, so that's quite chilly even for us here. All right, so I'll give everybody a second to get acquainted with the webinar administration panel. There is a chat area and a questions area. And what I would do is probably take a look at the questions area so you can find it if you want to ask questions during the presentation. You may even want to open that window into a separate window on your end. And you do that by clicking, there's a little arrow associated with each window. So you click on that arrow to the left of the X and you can open it up into a bigger window where it's a lot easier to use. So go ahead and take care of that now. Your volume very simply is controlled right on your computer. And if you lose volume or something happens during the webinar, let us know and we'll see if the issue is on our end or your end. And if everybody seems to be okay, then log out and log back in. That's usually the best way to do it. If it's a problem on our end, of course, we'll address that as well. Okay, so let's, if anybody has any questions, feel free to start asking that, of course, at any time during the webinar. I may wait to get to a specific time to answer your questions, but I will certainly get there. So let me just also introduce myself. My name is Bennett McDowell. I'm founder and CEO of TradersCoach.com. And I created many of our products that we offer on our website. I actually trade the markets, so these products were developed first for my own needs and then offered later on to everybody else out there because really we're not a marketing firm. We really started as a trading firm, and from this it blossomed into people wanting to know how we trade the markets, and thus the products, of course, came next. So trading first, products next, and that's kind of the order that I think everybody likes to see it. But we welcome you to our website at TradersCoach.com. We have a lot of free information. We're going to be doing some exciting new fun updates to the website through the year of 2014. We also got some great new software ideas out there. And of course, if you're on our email list, you'll be notified of what's going on. And so that's why it's a good idea to do that, as well as also join our Facebook page. If you go to Facebook and put TradersCoach.com in there, you can find us there as well. I've written 3 books that are in the market today called The Trader's Money Management System. I've written also a book called The Art of Trading and the Survival Guide for Traders. available at Amazon or some major bookstores in your area for sure. And basically, the money management book can be used by anybody, whether you're an investor, day trader, position trader, forex trader, futures trader, or stock trader. All right, there's methods in that book that are going to help you and get you grounded for good, solid risk control. All right, the art of trading. ART stands for Applied Reality Trading. This is really our Bible on how to use the ART software. And the ART software is a form, of course, of technical analysis where we're concentrating on trend trading, and we also have some studies for scalping the market as well. We also have a book out on the Survival Guide for Traders. That's our most recently released book. And this book focuses on how to run your home-based business like a professional hedge fund. In there we give you business plans, we give you a link to a membership area where you can actually download a pre-organized business plan that I developed that I use, and you can print that and make copies of it and so forth. Okay, I'm getting some feedback that the audio is not good. There's no sound. Okay, so no sound for you. How about anybody else? Sound is fine, good. Okay, hold on one second, we'll make a few adjustments. Okay, good. We wanted to check some settings here, and it looks like everything is okay. And everybody, thank you, everybody. Appreciate that. Okay, breaking up a little bit. Okay, we'll keep an eye on it. All right, you just let me know if it gets too bad. Okay. So anyway, these are the 3 books that we have out there, and from there also, I've got a new book coming out, and the new book I'm really excited about, and it's on the Elliott wave. And so that should be coming out probably in the first half of 2014. I've added some really cool stuff to the book. So it was supposed to actually come out in the winter, and I held it up a little bit because I wanted to add some new charts and some things that we saw happening in the market to keep it really up to date. So that's coming out, produced by McGraw-Hill. So we're really excited about that one. And if you like the Elliott wave, you're going to want to get on board with that. We also have to, of course, whenever we talk about trading, we have to talk about the risks involved in trading. And I think everybody is pretty good about that at this point. I think you understand that there are risks in trading. And, of course, without the opportunity, without those risks, there is no opportunity. So the two really go hand in hand. All right, so this leads us to our topic for today, top secrets for picking high probability trades. And so I'm going to share with you some of the methods that I use, and I run basically a trading pick service here, and we call it the Weekly Trading Picks. And we had a really stellar year last year, and we just started basically in October 28th of 2012. So we've really, since the inception, we've made about 399 trades, just short of 400, and we're up 992.71%. Our monthly average is there, and you can see the average days held on all closed trades, etc. So we've had a really good method of getting into stocks, risk control, and so forth. This information, just so you know, is available on our website. If you go to the home page and you click on results there on the home page, it'll take you to a copy of this where you can actually do your own research. We also give you every trade we made in 2013 on this service. So there's full disclosure on everything that we do here. And this is currently the results broken down by quarter, okay? And also, too, some of our big winners. Usually what happens is we'll get some really huge winners and some modest winners, and we cut our losers really short. Here's the formula we use for our calculations. I think it's good whenever you look at a service like this, you kind of try to figure out how they're calculating the return. We kind of keep it as generic as possible. In doing so, what we're doing here is we're not giving you an actual return on an account dollar size. What we're doing is we're giving you a return on the gain or loss based off your entry point value. And so that's a pretty standard way of doing it. But again, we have full disclosure on how we're calculating that, and we give you the entries and the exits so you can actually correlate that to dollars based on your trading account size. All right, so there's that link. If you want to put that, copy that and put that into your browser, you certainly can do that. We are making a copy or a recording of this session today, so that will be posted at the traderscoach.com website in the archive area, and we'll probably send you out an email with it too. But the key is that we want you to go and look at our returns. We want you to see that, you know, we don't win on every trade. But what we do very well is let the winners run and cut those losing trades short. All right, and then the next question is, okay, this is where we're going to get into the meat of basically how we do it here. So when I look for trading opportunities and markets, what we're trying to do is obviously find the best trading markets because we're really momentum traders. Where the difference between being a momentum trader and an investor is that an investor needs a diversified portfolio to spread the risk out. They're also basing their investment decisions on things like companies' management, the value today versus the historical values in that industry. They're also taking a look at historical returns on markets or industries or even sectors and determining, well, I need money in, you know, X number of years in the future. So based on the historical past, you know, I would make a certain percentage. So this is my investment horizon, and I'm going to go into it in this fashion. We don't do that when we talk about momentum trading. Instead, what we do is we focus on markets that are going to move and move quick. We're trying to get in on trends. We use daily charts. Occasionally, we use weekly charts. We are not day trading. We usually hold our positions anywhere from, you know, a week, if we're really hit one right, up to maybe 30 days. We have some we've been in 90 days. So it just depends on the market and how fast it's moving. If we're in something for 90 days, it means we're not stopped out. So it's still going. But the idea is we try to find the best and fastest moving markets. Okay? So then we locate key entries, exits, and profit zones. And we do this using the Elliott wave. We do this using Fibonacci extensions and retracements. One of the key methods that we look for, we'll discuss that, and that's we have two primary methods and then a few indicators that we look at to make sure it's the right timing to go into these, and we always use risk control. Okay, so that's the key. All right, I'm getting a question from DH. He goes, hey, that's okay, but what if 2004 is flat or the trendless year? How does your system deal with this? Well, you know, the S&P had a pretty decent return, obviously, in 2013, but it wasn't 900%. So basically what we'll do is we will still look and try to uncover, okay, markets that are going to move even when maybe the broad market is flat. This is actually a time where you'll need a service like ours more than you would have needed it in 2013. Because in 2013, it actually was pretty easy to find markets that had moved, especially once the Washington solved its physical crisis at the end of 2012, right? Everything just took off from there. When you get into more of a difficult market, like we're going to probably occur in 2014, I expect a change in trend in the later half of 2014. So we'll be shorting the market probably more at that time than we will be in the beginning right around now. So at that case here, we'll have to roll the trades over from a long to a short side. Now, when we do that, we always use risk control. So if we have a little bit of a bumpy ride along the way, we're still, in terms of the overall market, we're still looking at markets that are ripe to move in the direction we need them to move on based on the overall direction of the market. All right, so that's a good question. Thank you, DH. Okay, all right, so let's continue on here. We want to uncover markets in play or about to be in play. And when we talk about in play, we want to have markets that have good liquidity. These are markets that perhaps are starting to appear on the news. We're seeing sector funds starting to flow into them and so forth. So they're markets that are what they call in play. Best for short-term momentum trading. You have more traders, more momentums, and more quicker moves. Telsa, great example of where a stock that was coming into play was Telsa. And look what happened with that. There are many, many others. We also like to take a look at emerging global trends. All right, about a year ago, we started looking at the energy sector. Now, while that's not really as hot as some other sectors right now, there's some certain parts of the energy sector that we're excited about going forward, and we're starting to focus on some good opportunities in there. Natural gas is going to be a real big export for the United States, probably in the next 5 to 10 years, starting now. But ExxonMobil, for example, huge oil company in the energy sector, they're starting to build these big factories, so to speak, right on different ports around the United States where they can turn natural gas into liquid and ship it because they're getting ready for exporting these huge resources we have of natural gas. All right, not to mention oil that if we can tap it, we can get to it. So there's some emerging global trends that we watch for. We uncover emerging sectors, and we use what's going on in the world to help identify or steer us into these areas. And then what we do is we use technical analysis to find some of the best setups, because we do a lot of scanning in the market for certain types of patterns and so forth. But we always try to do it in a sector that we think is going to be in play. We do look at analyst upgrades and downgrades as well. And we find with analyst upgrades and downgrades, basically maybe 3 out of 10 is something we may want to consider, because when you're talking about upgrades and downgrades from a big brokerage, what they're looking at is something for their investors. So they're looking at long-term type of companies, bigger companies that are more solid for long-term growth. But they may be in a downtrend right now. So while they may be coming down, they may be a good long-term investment possibility now, but for a short-term momentum trade, we don't want to be there because maybe we don't want to be shorting that market right now if the overall market's doing better. Yeah, that company could turn around in 6 months and be a tremendous long-term investment, but from a standpoint of a momentum trade, it may not be as good. Now, occasionally, what we do out of 3 out of 10, we find some going in the same direction as the momentum. And if that's the case, then we want to be there. Okay, so the other thing is now we've talked about how we get steered to certain markets. We scan for them and so forth. And so what do we do next? Well, the next thing we try to do is take a look to see the timing. When is a good time to get in? Is the market already taking off to a point where if we got in now, we'd be chasing the market? And is it getting ready to do a significant correction before it goes higher? Now, an investor may not care about that, but again, as momentum traders, we care about that. So we want to try to make the most amount of money in the shortest period of time. So we look for certain areas where we like to get in, and then we use a whole host of technical tools in order to time it, and we call that the matrix of technical analysis, basically connecting the dots. We look for bracketed markets. We scan for these. We know big trends come out of certain types, not all, but certain types of bracketed markets. If we see a pennant, we look for those. We look for breakouts. Okay, sometimes we have breakouts on big volume, sometimes not. But we want to take a look at all breakouts to see if they are coming at certain periods during an Elliott wave count that may produce a significant trend. So we take a look at that. We look at what we call fractal 1, 2, 3 patterns in the market for our entries and to place our exits. The ART software, applied reality trading software we call it, basically looks for these types of patterns and draws pyramids. We look for reversal days or pivot patterns as well, coming off some lows or highs. We look for the market to be breaking trend lines, either in the direction we want to take the trade, or if we've been in the trade, we look for the trend lines to be broken to start exiting. We do a lot of Elliott wave analysis. And, Elliott wave, folks will say, well, Elliott wave works sometimes and sometimes not. Well, we got it pretty much down to a science in terms of probabilities. We understand you can get alternate wave counts, but if the alternate wave count is resolving both in the same direction, then we can still use that. If the Elliott wave's not clear, then we may choose not to trade that market. There's over 9,000 stocks and a host more of other types of markets that we can trade. So you're not stuck picking these marginal trades. So if you don't see a good Elliott wave pattern or a good pattern that you like to use, move on to the next one. We look at Fibonacci price levels. We find them extremely helpful for target zones and retracement zones. And again, I can't emphasize enough risk control. All right, this is an example, and we see these all the time, of a consolidated market and then a break from that market. Now, when the market is in between the green and the red lines, you don't want to be trading it. Wait for it to break out. It's a waste of time. Your momentum is going to be stuck in neutral until you break out of a channel like that. So again, as momentum traders, I don't want to be there. I can make better use of my capital. So I stay out of channeling markets, but when they break, then that means something. And you can see these any time of year, basically on any time frame, but you have to scan for them and know how to scan for them. And when you have a channel at the end of a trend, like a downtrend, and you have a channel and it breaks to the upside, then you go ahead and connect the dots on your analysis to see if this is the beginning of a new particular trend to the upside. If so, then you want to be there. When we look at trends, as I said, we look at the Elliott wave. And the Elliott wave, an impulsive or major trend in the Elliott wave, has 5 waves in it. Wave 1, 3, and 5 all move in the same direction, where waves 1 and 2 and 3 to 4 are corrections. And then there's little waves inside those waves, and you can see that in the light blue on the left-hand side as well as the right-hand side. And the right-hand side is a basic correction, and you can see these on the chart. And if you can't see them that clearly, then that may be a good time to move on because you may be in more of a complex correction. So we like to see clarity. We like to be able to go in and see a good wave count. We like to be able to see a correction and see a good correction before we are convinced that the correction is finished. We have to be able to identify it. So all this is important. And you see Fibonacci, we use that as well, and it's everywhere. Okay, Fibonacci is a summation of natural numbers, and you see it in all sorts of phenomena to do with nature. Even this one. Hopefully this one will wake you up. This picture will wake all the guys up anyway. All right, so basically it's everywhere. And here's an example of using Fibonacci, okay, back in 2013 for a wave 5 target zone. And a lot of people were calling for a significant sell-off here, but based on the Elliott wave count, the things that we look at in our Fibonacci target zones, we were expecting a move back to the upside. And for those of you that have been attending our Monday morning kickoffs or our TradeStation pre-market briefs that I do with Stan Dash, that we have been forecasting a wave 5 target zone where prices pretty much are at this point for quite some time. And here is it on a 60-minute chart. So the point here is it doesn't matter what time frame it is or how you want to look at the markets. These patterns occur all the time. Very important stuff. Here's Apple. Okay, we had a wave 5 target zone top on Apple. And on this one, what's interesting about this one here is that during the uptrend here, notice down here we had a wave 3 on the owl. We call this the owl. This is one of our proprietary indicators that helps us confirm Elliott wave counts. The owl has to have the highest peak during a wave 3 that makes sense with price structure. Then we had an A, B, C correction. Okay, down here. And then you had wave 5 up here. Then you had, notice, a negative owl here, and you have to have a negative owl for a wave 4, and then a positive owl again for a wave 5. Now, when we initiate some buy signals, for example, we don't want to go long unless we have certain things in place. We need a bullish owl. We like to have a pyramid. We like to have at least a yellow, or if it's a bullish trade, a green PTF. And so we look for all these things. And then we establish a wave 5 target zone to help us with our risk to reward. And that was what we use, the Fibonacci extensions. So it's really a matrix of connecting the dots. And this is the way in which we do it. Everybody may do it a little bit differently. But the idea is your edge becomes this combination of doing what you know how to do in a very quick and orderly, consistent fashion, and always have risk control. So after this top was reached, we were expecting a turn to the downside. We got it. All right, but certain things had to happen. The owl had to go negative. Okay, and it did. It had to break some of these key support levels that were formed on the way up. Okay, and it did. We had to get some pyramids to the downside, and those started to appear too. So we had a lot of things. We look at a lot of things to make sure that things are going in our way. And if we don't see them, guess what? We move on to another market. If it's not as clear as it was on Apple, then we avoid it and move on. And nobody's forcing you to trade. So wait and look for the best markets. And this is what we do with our trading pick service. We go through a lot of work to produce these weekly picks. And I'll talk about that in a minute. All right, risk control. This is another big one. What we do here with actual dollars, when we go in with actual dollars, is we will have a defined point to go long. We call this the trade entry price, and it's based off a signal that we use called a pyramid trading point. And this is a classic 1, 2, 3 pattern, all right? And so the idea here is this is 1, this is 2, and 3 occurs when it breaks the high of 1. And so if we see this and we're getting ready to go long, when prices get above the apex here, or resistance level, then we know we want to put our stop down here just below the support level formed by that price bar. And so in this example here, notice that we have a 5.75 raw risk in points, or in this case it's dollars. But the idea here, okay, is that when you do the calculations, you basically enter the entry price in here and the exit price in here, put your account size in here, and then we also talk about percent risk. Now, percent risk, what we suggest you do is use the risk of ruin tables and actually figure it out. We have something called the Trader's Assistant, which of course does this for you. But the idea is you want that percent risk based off your actual trading stats. So you need to know your win ratio and your payoff ratio. And in order to know that, you have to keep good records. And from that, you can determine the amount of risk you should be using on each trade in a percentage basis. So when we say 2%, we're also not saying that it's the amount you're actually going to be using for buying power. It's the amount you can afford to lose. So in a case like $50,000, when you have a 2% risk, it means you don't want to lose any more than $1,000. because that's 2% of your account size. All right, so if you have 50,000 here, 2% is 1,000. So when you put your entry price and exit price into this and hit calculate, it tells you your maximum trade size, and this happens to be S&P E-mini, is 3 contracts, and your maximum dollar amount if you get stopped out down here at 1162.25, you'd lose $872.50. Okay, so that's just an example of how you can control risk on your end, and we suggest you do that, of course. All right, let's move on to another example here. Here is a trade that involved multiple positions, even on the same trend. And what's interesting about this trade here is that the major trend was up, no question about it. So the idea here is that we wanted to take an entry when we could, and our first opportunity was here when we had these pyramid trading points. So this one gave us our first entry down here. All right, this was trade number 1. So we went up here to calculate our trade size. We put all the variables in here, okay, and this is what we could go long on if we wanted to trade this one. So the market moved up quickly, moved back down, zigzagged all around, came back up here. Our stop was way down here during all this, so we kept into the position. And then we got another pyramid trading point here, and so our stop moved from here to here. And now we have an interesting situation. All right, this is an opportunity for us to add into the trend if we wanted to. So you could add another position in, and yet the risk from the first trade is gone. So the trade risk is gone from the first position. So again, we get our trade size calculator out here, and we add into the trend again, and the trend kept going up and eventually got stopped out over here. Okay, now there was also some decisions we made during the way. All right, for example, this hyperbolic move here with a gap, all right, when we see this and we have a certain amount of percentage of profit and the stop is way down here, we may use this signal called an ART bearish 2-bar reversal to scale out of a trend here. So we may decide to take a third of our position off. And then after this correction works its way out, notice it's an A, B, C, and then moves out up and beyond here. Now we're getting ready for the next leg up, so now we can add back in. All right? So the idea here is if this was a first wave up, wave 2 could retrace 100%. So if that's the case, no problem in taking a little profit off here in case it does that. But you don't want to leave the trend because the trend is technically still up, and we were able to get back in as well. So this is just an example of the kind of methodology that we use. It's very structured, all right, and it's very definitive and consistent in how we approach the markets. This was a profit. This is what we like to do. This is 133% we made in 32 days based off looking for channels. The other neat thing is this indicator is another thing we look at. This one here is called the PTF, Precision Trend Filter. It's very easy to use. As long as it's green, you just find the highest high. Now in the beginning it was this one. We knew that prices based off this indicator alone, there is a 75% probability that you're going to get a higher high. And you go to the price bar with the highest high in that green area as it's forming. Prices moved up, it stayed green. So we knew, hey, there's another 75% probability we're going higher than that, even during you have a little pullback, and up it goes. And so then here it started to turn yellow or neutral real quick, but not red. All right? So as long as it doesn't turn red, you're okay. If it turns red, that's bearish. But neutral just means that it's neutral. It's not making an indication on this recent high. But then it popped up again, and it turned green again, and it pulled back and made another high. And then we got up into this area here where we had a area here where we scaled out, okay, some profits here. So basically what you want to try to do with momentum trading is move it along as quick as possible. Make your money as quick as possible. All right, let me just see a few questions coming in here. All right, what is the highest time frame you use for Elliott wave? Well, actually, and this is for Al. Actually, Al, you can use the Elliott wave on any time frame. If I trade the 2-minute time frame, and I see a really consolidated, bracketed 2-minute time frame, then I'll go up to a higher time frame until the Elliott wave becomes clearer. 9 times out of 10, when I do that, all right, it'll get to a point where it's showing that we're in a correction, for example, maybe on a 30-minute time frame, but that correction is represented by chaos on a 2-minute time frame. So I know I really can't trade that 2-minute time frame until we start to get out of the correction. And so you can actually get and see that. Sometimes the Elliott wave will be so clear when it breaks out of that correction, even on the 2-minute, that you can start to see the waves inside the 30-minute. So you can use it on any time frame. We use it also on the weekly time frames. Okay, if we find things on the daily time frame not quite as clear as we expect, then we'll go to the weekly to see if there's any clarity. And if there's not, then we'll pass on the trade. All right, so usually we go about at least 5 time frames higher than the current time frame that we're looking at to look for overall trend direction. Good question. All right, DH, how do you determine the first wave peak off a bottom or corrective dip off a top in a series? How large does it have to be considered a complete wave relative to prior price action? Well, usually what we want to do here, and let's come back to this, and let's go to an actual live chart here. Let's bring up eSignal, my charts here for a second. Give me 1 second. All right, so let's just bring this up here. All right, for example, here's one. I'm going to talk about this one. But DH, if you have a stock you want me to look at, I'll be glad to look at it to help you clarify it. Otherwise, I'll find another one to match your question. This is one actually from our open trades list. And what we do here is basically you don't want to enter during this consolidated area. So let me get my pen up here again. So when the market is bracketed like this, okay, you have a high and a low, and this one's probably a little bit higher. So you got a bracket here. I'll try to draw that as straight as possible. I'm freehand drawing here, so bear with me. All right, so that's a channel, okay? And when I see that, all right, I actually kind of get excited because I know when the market finally resolves itself, we're going to get a break from that particular channel. And we got it, okay, obviously in a very big way. And our first heads up was when this indicator here on the PTF started to turn green where it had been red for so long. So we knew we were seeing some type of positive action. And then it has remained green for the most of the time at that point. And then we started to get some very sharp trend lines once it started to move. But we actually entered this trade on 12/30 at 1364. So if we take a look at the diagram, find 12/30 here, we're going to find it was a gap open fill. So it was right around here. Okay, there. All right, so it opened at 1364. Okay, our order was actually in at 13, so we didn't get that good of a fill. But we have market orders in, so we go with the flow, and we got in on this one. All right, so then the market took off, and now it's up. It closed at 24.64. I don't think you have to be a mathematician to figure out you do a couple of these in the year, okay, and you're going to do really well. This is the classic let your winners run, all right, and cut your losers straight. Now, we're not rushing to the doors to jump out of this stock yet. Yes, it's gone up a tremendous amount. We scaled out of a little bit, but we want to stay with this trend. If you think back to Telsa, for example, let's take a look at Telsa. Let me just erase these lines here. But if you go to a stock like Telsa, when that broke out from its channel, okay, notice here during the breakout, okay, if you had gotten out here based on emotion, all right, you would have missed a great deal of the trend. So you want to stay with these trends for as long as possible. That's the only way you're going to make the big money. Now notice here we're in a wave 3, and this is an ABC correction. So here, let me just write this down here. A, B, C. Okay? So that's an ABC correction, wave 4 bottom. So we've got a green PTF. All right, we're just about breaking the trend lines of the correction now. So we're going to be very aggressive and go long on this. Now, the question is, where do you put your stop? What we have to be very careful about here is stop placement, because if we're still in, if this is wave 1 all the way up here, then wave 2 can retrace down here and stop us out before wave 3 kicks in. We don't want to miss wave 3 of 5, okay? So this is a major 3, this is a major 4, and this would be a major 5. But they're waves inside waves. The other possibility is this could have been a 1, 2, 3, 4. Now we're going to work in 5 and kind of stall out somewhere around the 200 level. So we want to look for aggressive long positions, okay, at any time here, and be very careful about our stop placement. All right, so to answer your question, DH, we look for a clear wave pattern. So if we're at the end of a wave 4 and we see some, for example, like here, an end of a bearish wave 4, and we see some buying power come in and wave 4 hits the right Fibonacci retracement level, and so everything aligns up the way it should, then at that particular point we have a pretty good idea that we've begun the next trend. Likewise, if you're at the end of a wave 5, whether it's bullish or bearish, if you can clearly see, like an Apple, remember Apple? We could clearly see that wave 5 high, that top, being reached in a Fibonacci price target zone, and then it broke to the downside and it started taking out all those support levels, and it also turned our histogram, owl histogram negative. Then at that particular point, you have a pretty good idea it's rolling over. All right, so let me move on here, and here is a question from Beatrice here. This is the best risk control method. I made a big step forward by using your position sizing calculation. Look forward to an even better year in 2014. Well, thank you, Beatrice, and I think for everybody out there, risk control is about the only holy grail in the market. The next holy grail is getting your act together to a point where you can look at a market and you've got your entire trading system so internalized, you're going through the checklist of what needs to be checked on a consistent basis without getting emotions involved. That's the next holy grail. But it starts with risk control. Risk control keeps you from losing a ton of money. And once you're good, it will actually keep those losing trades so small that they'll be insignificant. Thank you, Beatrice, for sharing that, because it's what also I think it's a good thing for people to hear, that this is something that everybody can apply. All right, Ed, do you trade ETFs and stocks as well as futures? Yes. On the pick list, we changed the pick list. We used to trade Forex. Last year in 2013, we had Forex and futures on our trading picks list. But we did a survey, and people wanted more stocks and ETFs. So we keep the trades to 10 new trades a week, and out of those now we do 8 stocks and 2 ETFs. And what we've found is with the ETFs, we're able to capture, if there are any good futures like gold or anything like that, well, you can just use the ETF, GLD. If there's any currencies moving, you can use the ETF for that too. So the ETFs kind of was a nice way to work it all into a nice way. The other nice thing about sticking with ETFs and stocks in terms of percentage gains and loss, they're easier, because a 1-point move in ETFs is the same as a 1-point move in stocks, whereas on the futures market and on the Forex markets, a 1-point move is not the same. So it's much easier to compare results on those particular types of markets that are all the same. All right, so let me move on. Thanks, Ed. Beatrice, can you sequence connecting the dots together, the 1, 2, and 3 of what you look at? Yeah, when I look at a market, I'm no kidding. I literally can look at a market at this level of where I'm at now, and probably in 10 to 20 seconds, I can pretty much figure out if I should be long, short, out of the market, and if I can't, then it's just time to look at another market. It's only, it's like anything else. You do it long enough, and it becomes so internal that you're going through the checklists already. Now, what's interesting is when you're first starting out in the markets, all right, you really have a hard time doing that, because unless you have a proven track record, and if you don't, you should be simulated your trading, paper trading, until you do, because if you have that to a point where you're profitable on paper and then go in with the real markets, and you have your risk control down, then when you encounter emotional difficulties because you have risk control, you're not going to lose your shirt. All right? You might not follow the same trading plan you did when you were paper trading, but at least you know at that point that the reason why you're failing is because of emotions. But if you keep at it, what happens is that trading becomes just like another business. In the beginning, I think it becomes a little bit more like Las Vegas. But after you've been doing it a while, you realize that, hey, if you miss an opportunity, there'll be one next week. In the beginning, when you miss an opportunity, you're throwing the stapler out the window. You're mad, okay, and that creates emotions. So eventually what happens is you settle into this frame of mind where you can look at charts objectively and then go right down the 1, 2, 3s. For example, first thing I try to do is find wave 3, okay, on any market. And so if it, obviously there's not a wave 3 here, but there might have been a wave 3 back a long time ago. If I don't see one, I look for a channel. And then I look for opportunities coming out. I'll take a look at different time frames. But if I spot a wave 3, all right, and it makes sense in terms of what the owl is telling me, then the next thing I look at is where are we in relation to that wave 3? All right, are we in wave 4 now? If we just finished a wave 4, are we in a wave 5, close to a top? Is it too late to trade wave 5? If it is, then I'll put that market on a watch list and I'll short it when it gets to the top of wave 5. Okay, so it becomes that quick. And you look at all these tools. For me, I look at the tools below as well, because I'm looking at things like what's the owl doing, what's the PTF doing, and what's the trend line master doing at the bottom for trend line identification. Trend lines are a great way to very simply see what's going on in the current trend. Is it broken the trend line or not? I mean, it either has or hasn't. So you go through it just like that. Good question. All right, Mark, what is your definition of a triangle, and exactly what is it plotting in its structure? The triangle, Mark, looks at what we call 1, 2, 3 patterns, or fractals in the market. They're also known as. But if you notice here, every time a triangle forms, okay, it is associated with a pullback. All right? So what happens is the art software looks for these 1, 2, 3 patterns. This would be 1, 2, 3. Now, before there was software, basically I used to draw these out on charts, okay? And that's what I would do. But with the software, we programmed it to do it for us. Now, the nice thing about the software is there's one other thing that's really important that it does. It's looking at the momentum in the pattern that's forming. See, some 1, 2, 3 patterns, like this little one here, didn't form a triangle, okay? This one didn't form a triangle here, okay? This one didn't form a triangle. All right, so not every 1, 2, 3 pattern creates a triangle. And the reason for that is simply because we are looking at the momentum that's involved in identifying those particular patterns with the highest probability. And we basically base this off previous statistics of running the system. So we're looking for the best entries and exits, or another way of saying it, the best 1, 2, 3 patterns. And so obviously if we break out above the top of a 1, or an apex of a pyramid, in other words, then that's pretty good. That's a sign the trend is continuing, and a logical place to put our stop is at the bottom of a nearest pyramid. So that's how we do it. All right, so it takes into account momentum and 1, 2, 3 patterns. All right, let me move on. Beatrice, what do you use to scan for the bracketed markets? Beatrice, I actually use the ART scanner. We have a scanner that plugs into NinjaTrader's Market Analyst. It plugs into TradeStation's radar screen, and it also plugs into Multichart's scanner. And what that does is it really looks for these type of bracketed markets. We have a program, have it pre-programmed for the kinds of setups that we like to search for in bracketed markets. Okay, so that is definitely in there. All right, let me just bring up Netflix here if I can. Let's let that load a second, and I'll answer some other questions in the meantime while that's loading. Okay, so let's see what we got here. What is your definition of the triangle? Okay, got that one. How do you scan? Got that one. Okay, Telsa, why is that the first 2B point, not the end of an A? We'll go back to Telsa and take a look at that in just a minute. All right, so let's take a look here at Netflix for a minute and go back in history on this. Now, a lot of you have been coming to the trade station, pre-market briefs, have been following me a long time. We were looking for a bottom on Telsa quite a while ago, and we got it, okay? And then the market started taking off after this. Now, here was a major move to the downside, 3, 4, bottom. Then it took off. And so we kind of were looking and waiting for that. And as you can see, you had a very sharp owl here. This was a 3, 4, and 5. We had a 4 with a positive owl. All right, so we had a 3 here, 4 here, and a 5 here. The owl made sense. We had a positive for wave 4, okay, and then we had a 5. Okay, so that's how that looked. So basically, when we got to the end here, if we're right, we would start to see bullish divergence in the owl. So here is this, and here we're having a lower low in prices here, and the owl was not getting as low, so we had bullish divergence. That's good. All right. We still didn't really have a green, solid green trend line, so we had to wait for that. We also had to wait for a couple of other things. If we open this up here, we had to wait for some significant bullishness to come in to take out some of these support levels, which are now resistance levels on a new uptrend. And so, you know, we didn't go right in the market. We waited, okay? We waited until this level was broken here. We happened to get a pyramid at the same time. We don't always get that. Sometimes we have to wait for them after here. We also had a green trend line. We had a neutral PTF, but it's okay to go long on a neutral, and we had a bullish owl. So this was an indication. We had a pretty good idea based on the Elliott wave that this was 5. So this was a boom, okay? You take it, all right? And you use risk control in case you're wrong. All right, it's not an exact science, but you go with the probabilities. All right, now on Telsa, going back to DH's question here, why is that 2B point not the end of an A wave? Let's see. I'm not sure I'm going to know what you mean by which 2B point. Is it this one you're referring to here? Not sure. Okay, so let me know on that, okay? Okay, oh, you're right. We are still on Netflix. Thought we switched over. Hold on. Okay, so what are you saying for the 2B? This one here or this one? Okay, so this one here. All right, well, let's talk about that. What if that was it? Okay, what if this was A and this was B and this was C? Would it make any difference in this bottom being a wave 4? Okay, so there you have it. Okay, it could be just like that. If you drew it like this, if you said this was a broader A, B, and C, all right, you'd still come to the same conclusion. So there, you know, there's a difference in looking at it in alternate wave counts. I really can't count based on this one, the 1, 2, 3s in here. I can count them better. 1 and then 2. I can count that better as an A, B, C that way than I can the other way. but as long as that bottom, okay, is definitely a 4 and not something else, then both alternate wave counts come out the same. So you're okay. All right, let's move on here. All right, let's see here. Okay, Sharon, I appreciate the risk control because I'm a natural overtrader and have been losing because of the lack of risk control. But that's okay. The risk control will save the day. As you do this more and more often and get more experienced, you won't trade be an overtrader. You just got to stay with it. The key is not to lose all your money before you get to that point. Okay, and so you subscribe to our pick service. Good. Okay, good. Excellent. All right, Stanley. Hi, Stanley. How is the Trendline Master used? What the Trendline Master does is it's actually 2 studies in one. It creates a ribbon at the bottom, okay, here. Creates this ribbon here. And as long as it's green or dark green, you're okay. When it starts to turn red, that means the trend is changing. It penetrated, before it penetrated, it had a line like this. So once it penetrates the line, then it changes color, okay? So it's an automatic trend line drawing application, and it works really good. So it's another way in which you can look at a chart and help you surmise if you should be long, short, or out of the market. Now, if you don't like all the lines drawn, you can get rid of them, okay, and just have the ribbon at the bottom. So that's why we included the ribbon. But that's what it does. All right, we're getting close to the end here, so let me move here pretty quick and see. I'm going to kind of pick the questions out here, okay. Okay, Lee is asking, is the performance on specific entries and exits that were known in advance? Absolutely. What good would it be if we were giving you results based on entries and exits on history? I mean, that wouldn't be fair. So it's actually, you know, the trading picks that we deliver have entries and exits, and we basically give you 10 new ones each week. Let's go back and take a look at a couple things here. Give me 1 second. I want to make sure you can see this okay. All right, so let's take a look at a couple things here. I want to see here. Okay, so I want to talk to you a little bit about how this works because I think it'll answer some of your questions that I see up there. Basically what happens is this service is a subscription-based service. We got a lot of subscribers. Because we have so many subscribers, we offer this thing at a pretty decent price, I think. And I think anybody out there that's here will agree with that, that it's a very reasonable price for what you get. We could charge a lot more based on the returns that we had. But, you know, we do well running the service because we can keep it this cheap, so to speak, because as long as we have the subscribers and have the returns, all right, people flock to it. But how does it work? Okay, well, every week we give you 10 new picks, 8 stocks and 2 ETFs. And it takes us quite a bit of work to deliver these particular picks because we're looking for good, solid momentum trades. We give you the entry price beforehand. We give you the exit price if you're put into the trade. We also give you a target zone, all right, that we expect to reach. And then we also give you the symbol, of course, and you can look it up on your chart. We always use daily charts, okay, for our entries and exits. Again, this is not day trading. This is position trading. So what happens is as the week goes by, we update the stops once a week. We do not micromanage these trades. Now, if you're using a trading approach and you want to try to get involved and do even better than we can, hey, go for it. But we do it once a week, and we found that works just beautiful, okay, because these trades, if you tend to micromanage them, won't do quite as well as if they're moving in your direction, let them go. The stops in place are usually good and will maintain good until we take a look at it the following week, okay? So we look at the stops every week, update them as necessary. If some of the picks do not get hit for that week, other words, they're not in, we look at them again to see if they're still good and valid. If they're still good and valid, they drop down to an outstanding pending list. So some of the trades that don't get filled, we don't get rid of. We drop them down to another list of pending trades. But if we feel the trade for some reason isn't working out or not going to work out, we haven't been put in it yet, so it's not an open position, then we have the right to cancel it too. And we'll tell you if we do. But the idea is then every week we give you 10 brand new ones. So, for example, like in the beginning of this bullish trend that we had in 2013, all right, we had a ton of stuff getting hit, but we also had some smaller caps that weren't yet moving, and so we kept those in the pending list. Those all started getting hit in the spring and summer and are just taking off now. So it's kind of interesting, the fact that you can wind up with a list of a lot more than just 10 pendings. You can have quite a bit on there based on what gets hit from the previous weeks prior. The subscription price is $49.98. We charge it automatically once a month. All right, so if you decide to subscribe, all right, the idea is that if you want to cancel, all right, you actually cancel right in the same area where you get the picks. All right, and that'll cancel any future subscription months, or otherwise it's automatically billed. It's automatically charged to your credit card. So all the charges that actually go through in a subscription are non-refundable. All right, so if you try it for a month and you don't like it, then you're going to be out $49.98. Okay, we have very few people leaving, just so you know, very few. All right, so let me see if anybody's got any questions on how it runs. Right now, Jeannie's got this at $49.98 till Friday. Normally it's $69.98, and so that's a good price. All right, let me see if there's anything out there. All right, so Mark, so the subscription provides 10 picks minimum each week, not month, each week, but can have more than 10 at any given Sunday. In other words, what happens, Mark, is if I give you 10 picks this week, and then next Sunday comes, and let's say there are only 5 of those 10 picks were triggered. So what do you do with the rest of the 5? Well, I look at them again, and if they're still good picks, then I'll drop them down to an outstanding pending list, all right, and add another 10 new. So now you have 15 pending picks going forward. And then there's an open list. If they get triggered, they go on to what we call an open list. And from that open list, those are our active trades. And I'll go on there every week, and I update those with new stops and so forth. And then once they get closed out, they go on a closed list, and that's where we calculate the returns and running totals. Okay, do we enter a limit order at the suggested entry price and wait to be filled however long it takes? This is a good question. It's really, I leave that pretty much personally up to the individual. I've been using market orders, okay, and a lot of times we don't get the perfect fill. We get a gap open. But for example, you know, if I remember showing you that one stock where we got a gap fill, you know, if we didn't get filled, we would have missed that whole run. So we use the market orders we use stop market orders. So when prices reach a certain level, it turns into a market order. That's a great question. But we have some people, you know, that don't have large trading accounts and may have a bunch out there that don't want to have market orders in. So again, there's a little bit of flexibility in how you want to do that. Okay, Jerry's asking, what is the scope of the population that picks are taken from? There is no scope, okay? I don't focus on whether it's an S&P 500 or a mid-cap. I go with what markets look to be doing well. For example, many of our picks at the latter part of this bull run that we've been in all year are smaller cap stocks because you have stock rotation. In the beginning of the year, we were hitting most of the larger caps. So I don't try to say, okay, I'm going to have, you know, 3 picks from the S&P 500, 2 picks from the one area, because I don't want to do it that way. I want to go with what's hot now. Okay, let's see what else you got. Do you send an email alert? No. No email alert is necessary because you have an entry and a stop already in place. That stop is liberal enough that it should handle most normal news. If you get stopped out, then you need to be stopped out. All right? If the market is moving in your favor, then we'll move that stop later on. Great questions. Are the ETF picks leveraged too, like TNA? They can be at times. And don't worry about asking too many questions. That's fine. Yeah, they can be. It depends. Again, if I see a clear pattern, all right, then I will put even a leveraged ETF on the hit list, and it will say what it is. So you'll know it's leveraged. Then you decide what position size you want to take based on that. Let me keep moving along here. Futures market actually has done really well. Okay, you can take a look at all the closed futures and Forex trades, rather, for 2013 and do the calculations. But they have done really good. But don't forget, you're not getting Forex trades anymore. Okay, so basically everybody wanted stocks, and we wanted to keep the ETF so we could play some futures in that fashion. But there's no more Forex markets on this. Okay, let's keep going here. Dennis, okay, thank you. You're welcome, Dennis. Glad to have you. Here's a good question. Do you have sell short in the trade mix? Yes. Ted, I got to be honest with you, we haven't shorted much recently for obvious reasons. But there are a good percentage that are shorts. But we try to stay going with the flow of the market. Now, when the Dow changes trend, okay, then you'll see more shorts than longs. Typical duration of a trade. Again, if you go to the actual full disclosure, we break it down to the exact number of days we're in each trade and actually calculate the average days for winning trades, the average days for losing trades, the average day for all trades. We also calculate the average wins and the average losses. Okay, let's see what else we got here. I'm going to stay on track for the questions coming in specifically for the trading picks at this point, since we're over on time. Okay, this is a good one. I will subscribe. I'm impressed. Thanks. The beauty is I do not have to learn your software, etc., since I'm partially disabled and cannot spend much time at the computer. Well, that's okay, because let us do the work for you. But you will need to, of course, enter the orders in, and you will be involved. And the other thing, too, is when we give you a stop and an entry, okay, that's what we suggest. If you find you want to deviate from the stop in such a way that as long as you're not increasing your risk, but if you wanted to trail your stop up a little closer and see how you do compared to us, you can do that, okay? So that's not going to hurt anything in terms of your risk. You may not do as good because then you get in the realm of micromanaging, but who knows? You may do better at times, and it may even out. So see how it goes for you. Okay. Okay. Bob, love your trading tools and services. Use them regularly. Great seminar. Thanks, Bob. You're very welcome. Glad to have you. Okay. Just so you know. Anything to do with trading, whether it's our trading picks or any system, it's never 100%. What we try to do is make the probabilities give us an edge. And that's really the best we can do in trading, that and risk control. And so The idea behind the trading picks is that it will really give you some direction and give you some really great setups that you might have missed, because it's hard to scan for all these. I mean, we spend a lot of time doing it. We have a lot of software that helps us take that effort out. So if we can, give you some picks each week that are really good that you may have missed, it's worth the $49.98 a month. And that's basically the feedback we've been getting from so many folks. And I got to tell you, if the market rolls over and turns south, you're going to need this type of service even more, because it's going to cause a lot of confusion as to what to do. And we also give you every week, we give you a general write-up on the market and the market direction as well. Okay? All right, so let me just give you this link here. Let me just see, let me go back. I'm going to go back a second on this. Let's go back and let me put up a link, because sometimes it's a lot easier to copy and paste these. So I'm going to put this in the chat area. Okay, so there's the offer link. That will take you to a landing page where you can check it out. Let me also put a performance link in so you can take a look at that as well. All right, so I want to leave those two links up here before we go ahead and end tonight. One of the things I just wanted to mention as well is there's a lot of times on the open list that we have when we have a stock that we're in, for example, we're in a trade on it. There's times when we'll put in a scale out suggestion, an area to scale out. All right. When we list a suggestion or a stop loss and it gets hit, okay, that is what we have to act on that and take that into account in calculating the performance returns. So, when we calculate performance, we're also taking into account multiple exits if we take them. So those returns, those percent returns that we give you are based on all exits, even if we're exiting more than just one time. Okay? Okay, here's a question. When you say trailing stops, do you mean an auto trail stop feature in TradeStation or a manual moving of the stop? Our stops are done manually, okay? So we're not using somebody else's method for a trailing stop. We do it manually because we have a certain way in which we look for good price levels, and it takes into account at times Fibonacci, takes into account the Elliott wave and where we are. If we're in a wave 1 off a new wave 5 or a new trend to the upside, then we're probably going to put our stop, try to get in as early as possible so we can put our stop at the very, very bottom so we don't get whipsawed in the beginning of the trend. Okay, so there it is. All right, well, I think they're telling me I got to go. They're telling me here that enough time has lapsed, and so we're going to call it a night here. And let me just see if there's any more slides. I want to thank everybody for attending, by the way. I know time is precious, so I appreciate that. Oh, here's some information for you in case you want to come to our website. We got a lot of free information there. You can check us out. We're going to be doing some exciting things this year, and one of them is certainly going to be the Wednesday night live sessions where we get a bunch of different speakers on here that are very good speakers and friends of ours that we know do such a good job, okay? Yes, this was recording, so Ted, hopefully if the recording works, sometimes these recordings don't always work, but if this one works, we will definitely get it posted in the archive section, okay? Okay, please post the link to join. Let me put that back up in the, it's called the VIP price, okay? And let's put that up there. And they do that because you're getting a discount off the normal price here. All right, so I put that in there in the link. If it doesn't work out of the chat area, copy it to a notepad and then paste it into a browser, okay? All right. Well, listen, if I didn't get to your question, I apologize. I tried to get to most all of them, okay, and tried to cherry pick them towards the end there, so we got to the ones that people needed answered regarding the service as well. So I want to thank everybody for participating and coming tonight. Again, this will be recorded. If you're on our mailing list, we'll mail this out again. But really, I'd give it a try and see what you think, okay? Again, if you take it for a month, it will auto-renew. So we got to remember that. Don't be surprised if you see another charge a month from now if you subscribe to this service, because it will automatically auto-renew, okay? You will get a receipt as well for each time it renews. All right, so there you have it, okay? Thanks, everybody, and we'll see you next time. I'll leave this page up for a little bit.